Hello, everybody, and welcome to another episode of Finance for Founders, where we dive deep into the world of business, innovation, and leadership. Today, we have an extraordinary guest joining us, a true powerhouse in the world of finance and strategy. Salvatore Tirabassi is a seasonal fractional CFO, investor, and business strategist with over 20 years of experience helping companies unlock their true and full potential. From his expertise in financial modeling and analytics to his unparalleled track record in capital raising and mergers and acquisition, Salvatore has been instrumental in driving transformative growth for businesses across industries. But that's not all. Salvatore also brings a unique perspective as a venture capital and private equity expert. He's facilitated over 400 million in equity and debt fundraising, successfully guided companies through strategic exits, and even structured innovative tax advantage strategies for cash flowing businesses. Beyond the numbers, Salvatore is deeply passionate about empowering business owners to achieve long-term success, whether it's coaching leaders, serving on boards, or crafting actionable strategies for profitability. He's all about creating sustainable value and making an impact. Today, we'll be exploring Salvatore's incredible journey, his thoughts on navigating the challenges of scaling a business, and his insights into ever-evolving financial landscape. So, without further ado, let's welcome Salvatore Tirabassi to our show. Salvatore, how are you?
I'm good. Thank you for having me. I'm looking forward to the conversation.
Fantastic. I'm sure you are humbled by the intro.
That was quite an intro. So very good preparation. And I appreciate the way you described everything. So thank you very much for that.
Fantastic. So, Salvatore, what we do before we start, we had a request from our audience that we do some quickfire questions to our guest so that our audience get to know a little bit about you before we even get into the interview. So I haven't shared these questions with you, but these questions, try not to go beyond 5 seconds in terms of answering these questions.
Okay.
All right. Fantastic. So question number 1. What's the most rewarding part of being a CFO?
I think the most rewarding part for me is working directly with the founder owner and helping them recognize real practical ways that they could change some of the things that they're doing to have immediate impact in their business. I'm all about quick wins, and there are always opportunities to get quick wins that eventually aggregate and build up to something much bigger and better. And they're very appreciative of the quick impact.
Fantastic. Equity or debt? What's your go-to for scaling a business?
I mean, it all depends. You know, I have a gourmet knife manufacturer that I work with now, and we did an asset-backed lending facility, and now we're going to go out and raise equity. So in that case, it's both. But I would say for founder-owned businesses that are looking to scale, it's really ultimately a strategic and personal decision for the founders, because obviously with equity, you're going to change the dynamics of how the business is governed. Whereas with debt, you can kind of maintain the governance with the founder. So, and then there's also the practical reality of what's available. Sometimes it is, I do find debt for smaller emerging companies, depending on the type of business they're in. There are, if you're looking for small facilities, especially in the US, there are more options for talking to people and getting in front of potential investors pretty quickly. Equity usually needs to be a bit more structured and takes a lot more time.
But that's it. What's one financial mistake businesses make that keeps you up at night?
I would say that not all, but a majority of the businesses that I get involved with that are founder owned and operated don't have as good of an understanding of the relationship between their profitability and cash flow, and the cash flow down to sort of the weekly level matters to some of these businesses, and that can be stressful for them. And then it's something that I have to really kind of think about and help them get out in front of. So I would say weekly cash flow management in situations where that's required. That's not all situations, but it's for bootstrap businesses, it's pretty common.
If you could only use one financial metric, I think you've kind of touched on this, to evaluate a business, what would it be?
I would say the return on the customer acquisition cost, and also I would combine that with, sorry, you asked for one, so that would be my first one, but I would add on to that also the length of time it takes to go from initial customer pitch interaction to actually closing them. Those two things I think are fundamental to being able to scale a business. How much you're spending on and getting the customer, and then how long does it take to get them?
We're going to speak about that a little later on, actually.
Yeah.
And comparing the CAC and the LTV as well. But we'll touch on that. What's your favorite book, business related or otherwise?
One business book that I recommend to a lot of people is Never Split the Difference. It is written by, I probably should look this up because I'm terrible at remembering authors' names, but let me just get the author's name so you have it. It is by Chris Voss, Voss. He was the top hostage negotiator for the FBI in the US for a number of years. And the book talks about all types of negotiations techniques in a very practical and usable way. And he relates it not just from, life or death situations, but even to kind of how it applies in kind of any day-to-day interaction that you're having with anybody, or, basic business negotiations. So that's one book I would recommend. If I was going to recommend a fiction book, I would recommend Swamplandia, which is by Karen Russell. It's a book about living in the Florida Everglades.
Excellent. And next question is, what is a must-have skill for future CFOs?
I think 100% they need to have a fundamental understanding of data models in the world of analytics, and how to understand data repositories, how to have clean data, what are the methods for doing that, and then how to connect to those repositories of data to financial information and financial data so that they can make much more sophisticated decisions on behalf of their clients or the businesses that they're in. I don't see that you can get away from that in this day and age. It's critical. And I think one of the reasons why I really point to the data models and the data repositories is because they are often messy, and the CFO is in a position of leadership that can help drive the necessary changes that are required in order to get those data repositories into a condition and quality that is usable by the rest of the organization, and be able to establish that as a priority so that it actually happens. One of the issues that I see is often that the data wrangling and I just recently wrote a blog article related to this. The data wrangling and the data gathering and holding is kind of viewed as an IT responsibility. But one of the issues with IT is that they have a lot of competing priorities for making things happen in the business. They need to change CRM workflows. They need to update different systems that the organization's using. And the data that's used for decision making, which really, in my opinion, should always flow through finance, can kind of get left on the back burner because it's viewed as an internal resource and requirement. It's not necessarily customer facing. It's not impacting something that's going to immediately bring in new revenue. So it can kind of get forgotten about or deprioritized. And that's where the CFO can make a difference, because the CFO is in a leadership position to say, hey, this stuff is really important. We need to elevate where it sits on the priority queue. And then once you get a hold of all that information, you can make use of it. Then it really starts to turn on a flywheel and allow the business to do some really great things with it.
Absolutely. Tea or coffee?
Coffee.
What's the one place you would always wanted to visit?
The one place I always wanted to visit, I would say that I would really like to visit the Amazon and, get an opportunity to see what the world is like in kind of its purest form of raw nature.
Yeah.
I think second to that, I would say go to Patagonia, which is another version of that. But yeah, so I could do both in one trip, maybe fly to South America.
South America, the Amazon rainforest. Okay. What's your favorite holiday destination you've been to?
My favorite holiday destination that I've been to, I would have to say, is Maui.
Okay.
Yeah.
Okay. Um, what's a non-negotiable part of your morning routine?
Coffee. Yeah, coffee and my morning workout is a very close second, but sometimes, even if I have the coffee, I just don't feel like doing it. I've been good so far this week. What are we, Friday? We're basically 5 days into the week. I've been to the gym 5 times, so that's pretty good.
Excellent. Excellent. If you could have dinner with any historical figure, who would it be?
I would say definitely Albert Einstein.
And lastly, describe your leadership style in one word.
My leadership style is
in one word.
Open. Yeah.
Okay, fantastic. So that's the end of the quickfire questions. I like to think that our audience have got to know a little bit more about you. And so we're going to start with these questions first, Salvatore. We've seen that you've had an impressive career, from working with startups as a fractional CFO to managing over 400 million in equity and debt fundraising. Can you share the key milestones that shaped your journey and how you find yourself in a world of startups and scaling businesses?
So when I graduated from business school and an engineering, a graduate program in engineering, I went right into venture capital during it was 1999. I'm old enough to have experienced the internet bubble bursting. So I showed up for work. It was like August of 1999, and by March of 2000, it was a complete mess in the market. And I was working for a fund that was doing, emerging internet-related businesses. It was, early days where people were, building. There was no concept of like a Wix or a GoDaddy to go kind of develop a website in like 30 minutes or use AI to do that. Everything was developers were working on things from scratch. And what was interesting about that time was that I walked in thinking this is the big wave, but it ended up being sort of like the big pullback from the wave, which we haven't quite seen just yet, with AI in the world that we're in today, in this version of it, and this, huge bull market run that we're in. But back then, it happened in 2000. It lasted it was kind of no man's land for about a year. And I ended up going from trying to grow businesses to basically trying to save them, because the capital sources all ran for the hills. So I ended up doing some restructurings and buying some businesses that were being left behind without any investor support. So we got a few really good deals done, and then the market loosened up again and we did some more kind of growth deals. So I would say that was a very informative experience very early on, where I was able to look at growth and also difficult, problematic situations and figure out how to deal with both. There's different techniques that and ways that you can approach problems given how they're presented to you. If it's a straight up growth opportunity or a workout, and being able to do both definitely gave me a lot of good experience that I could then carry forward into a lot of different situations.
Fantastic. In August of 1999, what was the nature? What company were you working for? Is that something I can ask?
I was working for a new venture capital fund in New York City called Dolphin Equity Partners, which has now moved on, and they've got a totally different business model. So it's probably not a venture fund that you would have heard of. They lasted in that specific business model for about 2 fund cycles, and it was a difficult time for everybody in the market. There were very few funds that did anything extraordinary during that period because the implosion of the market was so strong that there were a bunch of people who had funds that had tremendous performance leading up to it, and then it sort of just all came tumbling down, and then everybody was kind of rebuilding from there.
How would you compare the landscape now? This is 99 to the dot-com burst in 2000. How would you compare the landscape then to now?
From an investor standpoint or from an operator standpoint?
From both.
From an operator standpoint, what's really amazing now is that there are so many more tools and the distributed labor that's available worldwide, that's accessible through different platforms, and the employment services that allow you to take advantage of all that. And obviously with world really being able to establish remote working methods that allow companies to perform without having to be in office because of what happened during COVID, it creates a tremendous amount of flexibility for operators to do things efficiently, less expensively, and gives them more opportunity to try and fail quickly so that they can pivot and figure out exactly how their business model is going to work. That is way different than it used to be. I mean, I just, to give you like an example of, a tool that is available that streamlines things. I have a client that has really just one person in IT. The guy straddles between information systems, but also development and connecting data and developing active workflows in the CRM for the business. And, he leverages Zapier to connect all kinds of data together, and maybe he has a database background, maybe he doesn't, I don't really know. But all I know is that, if I have a conversation with him and I'm wondering, is the data from the call center system being connected to the CRM for a specific thing that I'm interested in analyzing? He handles all that, and what I discovered is in the background, a lot of the data connections that he makes are through Zapier, so that back in 99, you would have had a couple to 3 people, building data in databases, figuring out how to get the data flows to work. Things would take much longer, and you couldn't iterate as quickly. Now, eventually, when that company scales to a certain level, Zapier may not work anymore for them. But what's amazing is that they get to figure it all out and actually make money along the way. And then when they're scaled and they need to go down a different path, they've got a whole system that works that they can then leverage into the next version of it that's more robust, costs more, but gives them more functionality, right? They can take baby steps along the way with tools like that.
Yeah.
And that's just one example. I mean, there's many others.
Absolutely. And we're going to dive into that a little bit more as well. I was going to ask you as well, for founders without a financial background, what's the first thing they need to understand about managing finances during the scaling phase?
I think first thing that they really need to understand is how a sophisticated financial forecast can be their best friend during scaling. And I always recommend doing monthly forecasts, monthly and then yearly summaries. Monthly, because when you're in that scaling phase, you need to have a granularity in the number of days that you're looking at from period to period where you can, you're effectively making decisions and that unit of time tends to work. I mentioned earlier, like the weekly cash flow forecasting, that can be actually directly related to the financial model. And that really would matter more in terms of companies that are trying to manage their receivables and payables and make sure that, they can pay everything and, have the business turn on itself week to week. But I would say the main thing is the sophisticated financial forecast with drivers in it, the ability for an entrepreneur to sit in a room with his or her team, change drivers and understand how it affects the business, and really be able to do quick reality checks about whether the assumptions that they've made to drive the business make any sense given what they most recently learned. And they're always sort of learning things as they go along. So you got to be able to turn those dials and see how it impacts the future.
Absolutely. Are you sometimes shocked or surprised where you work with some startups that in actual fact don't have all of these things you've mentioned? A forecast, a cash flow forecast, just some of these basic things that you think is crucial for the growth of a business don't actually have these things on ground?
I would say I'm not surprised. I would be surprised though if they didn't have sort of some version of it that is just kind of working for them. That would be very surprising. Although I have encountered that as well. I've been involved in, a couple of extremely messy situations that were pretty surprising that an entrepreneur would get that far out over their skis without, good information and data. But the more sophisticated stuff, no, I'm not surprised that they don't have it. And my whole methodology and my company, CFO Pro Plus Analytics, is basically that we bring that level of sophistication down to, this emerging growth level for for operators who don't have big backing behind them. And we really help them use these tools that they normally might not have access to for a long time. So that's a key part of the model for us. And it really does change pretty quickly how they operate.
Would you say for that reason, you've mentioned your model, would you say your model is more targeted towards companies that are bootstrapping?
So I've been doing this for a little less than a year and I've got 7 clients now. And, I get new requests for proposal, every month. But what I found is that most of my clients, except for one, are entrepreneur owned and operated, and they range from, 6 million of revenue to over 60. But I do have one that does have professional investors involved. But more commonly, what I found, at least with these initial clients that I picked up, is that they've been, founder owned and operated. And some have gotten, as I said, to like 60 million of revenue without a CFO. They have a that example, they have a fuller accounting team,
Yeah.
but they are missing the sophistication, and they are also the ability to really take data and be able to drive it through the finance function, which is really an important thing of what that in that specific example of what they need. But if you go down to the smaller revenue companies, it's changing out bookkeepers, putting in financial controls, financial forecasting, strategy meetings with the founders. It's all that type of work.
How do you bring their attention to the founders that this is what they need? The challenge that I've seen and I've experienced that they've grown a company to 60 million. they may not feel they've gone on without a fractional CFO. How do you go about communicating to them that this is a need that your company requires?
Well, most of them have a problem when they show up. They have already sensed that they have a need. The way I sort of describe it is like they wake up one day and they want to know what's going to happen in the next 90 days. And they don't really know, right? They think, they have some idea, but they really want to know, like, with numbers in front of them, if this happens, will this happen? If this other thing happens, will that happen? What's going to put me in the danger zone? Those are the things that kind of keep them up at night. And that's generally where the conversation starts. It starts with they have a specific problem and they need someone with the techniques and the capabilities to not just make tools for them, but also to really explain to them what's going on and give them a point of view on how to navigate what's in front of them.
Fantastic.
So, another example I could give is with some of the venture-backed deals that I've come across, they're usually being driven by the investors to say, hey, you really need some help being able to navigate this. And then they're coming in with like, hey, someone's advising me that I need this. I'm not quite sure what I need. Can you show me like the stack of services and how it works? And that's a slightly different conversation. The one thing I will say is that I related to this is I've met a lot of fractional CFOs since I've been doing this. I've done a heavy amount of networking, and I've met probably personally about on video chats, probably about 100 of them since I started doing this. And I met one who told me something really interesting. He had been doing fractional CFO work for 18 years. And he said, in my experience, the word founder and CFO are not used in the same sentence until it's very late. They're not used in the same sentence soon enough. And I agree with that. I think that that's generally true. A lot of the situations that I come into could be pretty dramatically different if they had invested some money in this type of service earlier on.
Yeah. I can agree with that. And some of my experiences with some of our clients that we work with echoes the same thing that you've mentioned just then.
Yeah. I think they sort of view it as a cost center and what am I going to get out of it? Yeah, I'm not sure. I had one situation where I was asked to provide a proposal and the founder was sort of operating in the background. It was very clear to me that he just didn't see value in any of this. And they were running a SKU-based inventory beverage business. And, they showed me their financial model, and someone at some point had built them a pretty sophisticated financial model, and they didn't want to pay that person anymore. So then they started hard coding and just making all kinds of changes to this financial model. And they had no idea exactly what the forecast was going to do. And I gave them a proposal and a price, and I knew it wasn't going to go anywhere. To me, I was like, you're in a working capital driven business where you're tying up a bunch of your capital in inventory, and you don't have a financial model or a forecast down to the weekly level where you can make decisions and moves about how much inventory you're going to bring in and figure out what you need to start discounting so you can start pushing money out the door and have a balance between, your inventory that's going to be high value inventory and the stuff that you just got to get rid of so that you can keep running the business. And I'm looking at this thing and I'm already, 10 steps down the chessboard as I'm looking to it, because I was like, wow, this is really not good.
Yeah.
But in that instance, the taking on the service just seemed like an added expense. And my view was like, well, yeah, it's an added expense, but if it prevents you from missing payroll, it's going to be totally worth it.
Yeah.
Right. Because that could definitely have happened in that situation. And I don't know exactly what they ended up doing, but it didn't work out as an opportunity for me. But I think it's a bit of, it's not don't view it as a cost center. You have to view it as a profit driver, because a profit and cash flow driver, which is essential to being successful in your business.
Yeah, yeah, yeah. Which is as important as marketing and the sales team, which I think a lot of these companies tend to put a lot of their investments toward because it seems somewhat tangible and they can see where their finances gone and it's helping them drive growth. But I think the way you just described it as a cost center as opposed to a growth driver, I think should ultimately change the mindset of how people view that without a doubt. You mentioned as well that you had 7 new clients this year. 7 new clients this year. How do you go about marketing yourself as a CFO?
I have my own personal blog and I have my CFO blog. So I run a couple of different websites and I have pretty heavy activity on LinkedIn. So I've got, one to four blog articles a month that come out, and then those get pushed out to social media. And I have a Substack that it gets pushed out to. So I've got Substack subscribers. So it's mainly a content-driven sort of presence thing, mainly kind of going through LinkedIn for now. I've got some other plans for 2025 that I'm going to try to execute on, but for now, that's how I do it. And then I've got a lot of people in my network who just call me up and say, "Hey, I've got this situation. Do you want to take a look at it?" That happens as well.
Fantastic. At the start of this show, we mentioned CAC, customer acquisition cost, and the LTV.
Yeah.
Both metrics are often, but not always, well understood. Can you break these down in a way that resonates with non-tech founders?
Yeah. So this is, I think, you said before, like there's a tangible sales and marketing and not tangible CFO services that are also can be a growth driver. And I think this is where those two things meet. If you're in a startup bootstrapped environment or founder run business and you've grown, you're going to have definitely some concept of your customer acquisition costs, but you may not have the granularity to say how that CAC changes in different channels, et cetera. And that's where the CFO services really helps, because it gives you much more detail about how CAC works in your business from your different channels across different salespeople, different client types, that kind of stuff. CAC for me is, I look at it generally two different ways. And obviously it can be bespoke for any business. So I'm just kind of giving high level, but I look at marketing spend related to the amount of booked revenues that you bring in as your marketing customer acquisition cost. And then I have one metric that I talk to my clients about there. And then on top of that, I'll then add in fully loaded selling costs, including sales management, overhead, commissions, all of that. And then I'll get a fully loaded customer acquisition cost to the conversion. So you get marketing cost to conversion. You can go one layer above that and do marketing costs to responses, actual people that you posed things to.
Yeah.
That's kind of one layer above. So if I do it in order, just to make it more clear, it's like marketing to response. How much is that costing you? That's sort of like your cost per lead. Then I do marketing to sale. That's your marketing cost to sale. And then what I'll do is marketing plus selling costs to the sale and give you the fully loaded cost. And then those three things give you the ability to actually monitor how the performance of each of those spending areas is, being dialed up or down and performing better or worse. Those also become very direct inputs into the financial forecast, so that you can go into the financial forecast and say, hey, if I spent another $100,000 a month on this marketing channel, how would that flow through and create more sales for me? So that's pretty simple. And I think you can just take that methodology and just go to a spreadsheet and pretty easily start to figure that out. Sometimes you get into timing issues, like I'm spending money today, but my sales cycle is 90 days, and I don't know if the lead came in 60 days from marketing that I spent 60 days ago. And then those types of things have to kind of get figured out so that you can try to tie your marketing dollars more effectively to when the leads come in. So those are other complications and nuances that, we figure out as we kind of go.
That's it. And how would you, somewhat you said it, how would you now recommend founders approach balancing CAC and LTV? Are there specific benchmarks or ratios they should aim for?
Yeah. So when I think of customer acquisition, and this metaphor varies slightly depending on your business model. But if you take it as a lot of businesses these days are trying to be subscription based or recurring revenue. The way I look at it is it's an upside down wedding cake, or and I'm sure some people have seen sort of the funnels that kind of look like this. But in order for you to produce a return on equity at the bottom of the cake, which is like that's the distributions and the cash flow that's available to the owners, right? In order to have money there, customer acquisition return, so revenue to customer acquisition spend, needs to be very, very large in order to have enough cash that's flowing through the different layers of the cake. So revenue, cost of sales, then operating expense, any interest or debt service you need to pay, and then you've got your cash flow. My view is that generally what I've seen in different types of businesses, if you can have a CAC, a ratio of revenue to marketing that is above 3x, so $3 of revenue coming in for every dollar of ad spend or marketing spend, you generally should have a model that can work. If you get to 2, can you make it work? Sure. It depends on all your other costs and expenses. Obviously, 4, 5, 6, that's, you have an incredible amount of room there. I mean, those are the types of businesses that you can try to scale, especially if they're recurring revenue. You can try to scale those businesses just on the back of the revenues that you're bringing in, because your paybacks are so tight when you're getting that level of revenue coming in. But I would say 3 is just a rule of thumb. I mean, and again, that's a very, very high level. 3 is workable generally. I've seen that in e-commerce businesses. I've seen that in consumer recurring revenue services. I've seen that in SaaS type businesses.
Excellent. So you just mentioned about the CAC and the LTV. What about CAC payback period? What is an ideal CAC payback period?
1 day.
That's
ideal. But I'm kidding.
That's the ideal.
Yeah. I mean, that's when you're printing money. I think ideal is a balance of working capital, right? And how well capitalized you are. So if you're not well capitalized, and can you get your paybacks? Can you afford to have paybacks that are 90 days, 60 days? That's really all depending on how much working capital you have, so that you can cycle more money back into the marketing and keep the gear turning. If you have a lot of working capital, yeah, you can probably, you can potentially deal with 6, 9 months paybacks. Also, the thing to keep in mind is that as a founder, what you want to identify is the marketing that does get you the shortest paybacks, and then you want to keep investing in those until you stretch them to a level that is, manageable, but is kind of forcing you to find a new channel that can get you back into a really tighter payback period.
Yeah.
Because what everyone usually knows this, but the more heavily you invest in a channel, the wider and wider the CAC is going to get, because when you discover the gold mine, it only has a certain amount of depth to it, and then you have to spend a little more, and the CAC gets spread out, and so on. And then you need to find another channel and try to find another gold mine where you can spend little and get a lot, and keep going from there.
Absolutely.
But I always recommend, like, if you've got a channel that's got a really nice payback for you, really analyze it and study it and keep investing in it to force it to expand the CAC to a level that's still manageable for you, but isn't, the way it was when it started out. But that's when you're really maximizing the channel. You're like spreading into the channel carefully and methodically. And then when you feel like you've tapped that out, you can move on to the next one. But ideally, you're working multiples of these simultaneously, and you're sort of figuring them out as you kind of go along.
Could you give me, when you mentioned about channels, could you give me an example, something maybe that you've experienced where you discovered a channel, but you had to go in a little bit deeper through research just to get a better understanding of it?
Yeah, like just let's say you're a direct-to-consumer products business. You're carrying inventory and you're selling digitally, and maybe you've got one or two brick and mortar retail channels that carry your product. Okay, so now digitally, the obvious thing is, you can compare your return on ad spend for Google. And in Google, I would say you've got multiple layers that you can look at, because you've got different types of keywords that might be targeting different types of customer personas. So to me, each one of those is a channel, right? And you can say, okay, one persona that I go after on Google are, young moms with young children or something like that. Another one that I go after is like women in their 30s who are becoming empty nesters or something like that. And you've got a channel that's potentially trying to target that persona, and you keep trying to figure out how to get more and more of that persona to respond.
Yeah.
And grow so within Google, you've got multiple channels that you're playing, because you're creating the channels based on the targeting that you're doing.
Yeah.
But then you've got a totally other channel, which is you could go to Meta and use some of their black box algorithms to say, hey, Meta, I discovered these types of clients respond to my ads. Find me lookalike audiences for these types. And then you go to Meta and you're kind of like, oh, I'm going to target the young moms with small children and the women in their 50s who are becoming empty nesters. You take some of the data from Google, and now you're in a totally different channel, and you're asking Meta to find you those types of clients, right? And then, so let's say they're selling some sort of houseware product or something like that to these categories of women. And then they may have, I don't know, I'll just make something up, like Walgreens or Boots, they get a relationship there to do, wholesale selling into a retail channel. And then that becomes a whole other channel for them. And then they need to figure out, that is slightly different, right? Because Boots or Walgreens is driving the marketing to those products and getting people to purchase in the store. But what will happen through that channel with this company is they'll have to figure out exactly how does that play with their overall margins, because when you sell through a wholesaler, you're going to be getting lower margins than where you're going direct to consumer. So you've got sort of a ready-made sales channel that's accepting your product, but you have to give them inventory, so it uses your working capital, and you have to take a haircut on your margin because you're selling to them at wholesale. And so that introduces a different type of CAC analysis that you need to do. But those would be like 3 different channels.
Absolutely. Excellent. For scaling business, we've spoken about CAC, we've spoken about LTV. What would you say are the most important metrics beyond that for a scaling business that founders should be on the lookout for?
I would say it's really looking at their cash flow conversion on a monthly basis would be a really important place to pay attention, because you're doing all this work on the CAC and acquiring the customers, and then you want to see the cash flow through your income statement and all the way through to your P&L, especially if you got heavy working capital requirements. So that would be a place that I would pay attention, because that's ultimately the capital that you're going to use to either raise more capital or to reinvest in the marketing funnel. So you kind of start from up here, but then the next place I would pay attention to is, all right, now let's go all the way to the bottom of that upside down wedding cake and see what's happening there.
Yeah. Yeah.
And then if it doesn't make sense, what's going on in between that's causing it to not be where we think it should be.
Absolutely.
I have to do a quick time check because I have a meeting at the top of the hour. Do we have a lot more?
No, I had so many questions we could ask, but I think we could hold fire. Maybe we could do a part 2. But I've really, really enjoyed this conversation.
We can I have, if you have some time again, let me just see when my next opening is. 11:30 my time, which would be in 2.5 hours. I can hop back on if you want. I'm assuming you edit all this, right? And you
Yeah, but I could do a
cut it
part
down.
1 and a part 2.
Oh, you can. Okay.
I could do a part 1 and
Yeah.
part. So 11:30 your time is about 4:30 my time. That'll be cutting it tight because I've got another meeting around then. But whether Monday, are you shut down for the holidays?
No, I'm around. I'm actually working on Monday. We can do the same time Monday if you want.
Okay.
Yeah, the same time Monday. You can if you just want to send me a calendar invite, and then I'll have it, and then we'll see each other again on Monday.
I'll definitely do that.
Okay, good. Hopefully this was a good conversation.
It was really good. I've really enjoyed it. Really, really
okay,
enjoyed it.
good. All right. Yeah, I
Excellent.
appreciate it. All right, so we'll reconvene on Monday and finish it.
Fantastic. Thank you very much, Salvatore. Speak to
Okay.
you soon on Monday. I'll send you an invite.
Thank you.
care.
Bye.
Bye.